Let's talk mining on this edition of the Equity.Guru Investor Roundtable. We're going to talk about all kinds of investor education. I believe Professor Galen Ingen has referred to it as Mining 101. And he actually did a hell of a job. You sounded like a professor on the last edition of this roundtable, by the way. It was very, very impressive, your macroeconomic. But you're going to go last.
Yes, please.
Before you will be Fabi, but before her will be the man in the gold mine, shaft, vault, the shell. He'll talk about streamers and royalties.
Okay.
And then we'll hear about juniors and producers and explorers and all that good stuff. But what do you got? Who are these people that are, floating around making money?
Yeah, for sure. I think in the past, you guys sort of know I'm a fan of gold and silver, but I'm also a big fan of royalty and streamers. They're sort of my preferred way of investing in precious metals for the long term. Very simply put, I have this nice little chart that I drew out, I guess, on Excel. Quite proud of it. But, I just laid out what a royalty and streamer is versus a typical mining operator versus the GLD ETF. And you can see here on all fronts, the royalty and streamer wins in all categories. And again, we'll break this down quickly. But essentially, a royalty and streamer company, think of it almost like a bank, right? In a way where they will give financing to mining companies. And in return, that company will give a royalty and streamer a stream, essentially, basically saying for every gold and silver that is now mined from this project in the future, we'll give you a small percentage of that as profit. So typically, royalty and streamer has so many benefits. I think it's not as risky as a mining operator. You have to look at capital costs. You have to look at administrative costs. You have to look at, capital costs, I guess, include rising energy costs. If gold and silver prices drop, the mining operator can't really just pause and say, hey, yeah, we have to stop mining because obviously there's jobs on the line and it depends on what jurisdiction they're at. It can get even complicated. Whereas a royalty and streamer can run a business with like 5 people. So you're saving a lot on that. And you can see here on my chart, capital costs and operating costs, the royalty and streamer wins against the mining operator. And the GLD ETF is also up there as well, but it's an ETF, so there's not much cost except the fees that you pay. In terms of leverage to gold prices, yes, the mining operator is also leveraged to gold price, just like the royalty and streamer. However, a royalty and streamer, when prices of silver and gold are dropping, the royalty and streamer, if it's run by good management, will take that time to look for more deals, right? Because they're betting on the reemergence or the resurgence of gold and silver prices to move higher, and they can get some good deals at that time. So that's a catalyst, in my opinion. So you have a catalyst where these royalty and streamers can do well in a bad market and in a good market for the precious metal space. And also you add in the exploration and expansion, and you also add in that dividend yield, because most of these royalty and streamers are making big money. And when I mean that, I mean like maybe the top 5. Of course, a lot of people know about Franco-Nevada, Wheaton Precious Metals, Royal Gold, Cisco Gold royalties. I believe, when this idea came out of a royalty and streamer, it was basically considered the best business model ever, because again, just the very low administrative costs, a lot of upside. And I really do think it's like the safest way, maybe besides owning the physical gold and silver, which, you can see I like to do that with my vault, is the best way to play precious metals for the long term.
Well, you sure do. Look at all that. I got to get over there. So their hands aren't in the dirt. Their hands are in the financing.
Yeah, in the financing stuff.
Fabi's going to talk a little bit more about people that got their hands in the dirt, right?
Yeah. Some dirty hands as well. So the term junior is actually quite interesting because it could mean, I guess, 2 different things when it comes to mining. One is a mining company that is very small, But usually the term is used to refer to a company that's still in the exploration or development stage. So basically, there's a company that has a project. They think or they know that there is a resource in the ground, but they don't know exactly how much they have. Or most importantly, they don't know how much it's going to cost to extract it out of the ground. And the big question is, can they sell it at a profit? Now, the danger with that is obviously the technical constraint of the resource. There's also the fact that sometimes in some jurisdictions, even if you have a beautiful, high grade, great metallurgy, you can extract it easily, cheaply, etc. If you're in the wrong place where people don't want your mine, guess what? You're not going to be able to build one. So jurisdiction risk is a concern. Make sure that people aren't trying to build mines in places where the community doesn't want the mine. That's also, something to look at. But another thing, even before that, is looking at the people. That's the number one filter that I use, especially so when looking at juniors, because it is very easy to set up a junior mining company compared to, a financial instrument that would be a streamer and a royalty company, or versus a producer. It's very, very difficult to find economic resources and to bring them up to production. You have to go through a lot of permitting and licensing issues. You have to invest millions of dollars usually to get all the technical reports that you need in order to make sure that it is economic to pull the minerals out of the ground. And so it is a little bit harder to mess it up when you're already in production, right? And so you're also a larger company, and it's easier to find good management to just keep things running and to maybe amalgamate, to buy different companies, buy different projects in order to make sure that you will not run out of the resources. That's much safer. When you're a junior, all you need sometimes, unfortunately, is a story and a piece of land, which means that the ratio of scam artists to real project is a little bit off compared to the other two types of companies. So what I like to do is look at the people on the team and on the board, and sometimes even the advisors. And then I will throw their names on CDAT, and I will try to figure out where else have they been? What have they done in the past? What are they doing currently with other companies? And then I try to take the one company, look back in time and think, okay, how are they raising money? How much are they raising at any one point? And where is the money going to? If you see that they keep raising at indiscriminate prices and they are investing a ton in marketing, then guess what? Maybe they're mining your pockets and not the actual resource. So people is the number one thing that I look at when I'm looking at a junior, because it's easier to fool newbies at the junior stage, unfortunately. And sometimes when we're starting in this game and we don't know any better, a good story will grab us, and that's how you lose money.
Yes. A cautious tale, which we appreciate, because
which we've all probably been through before.
It seems like
high risk, but sometimes high reward as well.
So. Exactly.
But know the people. You did bring up producers, and that's what Galen's going to mention here. So one step further down the line.
I'm going to talk very briefly about the opposite end of the scale of what Fabi was discussing. Now, what she has presented is a growth story, one that provides a tremendous potential for return for a smart investor. The unfortunate part is it does require a lot of due diligence and also includes a lot of risk. So you have to be careful about how you go about it. If you don't want to make that kind of decision, then the other option that you have, other than going to the streaming royalty and streaming services, is to find yourself a producer. Now, these are people, as the name sort of states, that are actually bringing the gold out of the ground, pouring it into little bars and selling it on the market. So these guys are they're actually making money. With juniors, you're always going to see a net loss at the bottom. With producers, there's going to hopefully be a profit and a revenue coming through the door. So why would you select a producer? There's not a lot of growth potential there. One, a lot less risk, as I mentioned earlier. The gold's already coming out of the ground. Two, there's a possibility of what they call a dividend, which Vishal discussed earlier on. So I guess probably as an investor looking at a producer or figuring out who you want to invest in, my choice would be the ones that are actually paying dividends, because in some cases there's not a lot of growth to happen. You might get a little bit of a bump over the next 10 years of the life of mine, but it's not going to, be, leaps and bounds. A company that pays a dividend gives you a ready resource to sort of throw into your RSP, and it's something you can throw into other things as you go along. It's a nice steady pull. Now, you may just think off the bat, well, I'm just going to grab the guy with the biggest dividend payout. Well, the thing is, there's an inverse ratio going on. The bigger the dividend payout, most likely the less the revenue. So the actual, at the end, the earnings per share are probably going to either equalize or even be a little less than what you would get typically. For instance, I'll just, two guys I was looking at here. You've got gold, no, hold on, here it is, where is it? Hecla Mining. Which,
okay.
Yeah, they are a huge producer. They give you a dividend at the end of the year, as whatever their dividend payment schedule is, of 0.71%. You may look at that and gag, but basically they produce. Hold on a second. Oh shoot. Oh, geez, Louise. That was a horrible example because they didn't actually put the yearly dividend or yearly revenue in it. That really sucked. Okay, all right. We'll go to the opposite end of the scale just because I feel like an idiot now. If you're going to
do you want
invest,
production numbers or?
well, yeah, I was hoping looking at the revenue. For instance, Royal Gold. Okay. They provide a 1.19% dividend payout. Now, you think that's a small piece of the pie. Like, I'm not going to get that much, whatever. I mean, typically, you're not going to get everything. You should just take that out of your head. You're not taking home the profit, they are. But you are getting an excess of what that is. And so that company produced the revenue of 162 million. So that's a lot of cash to be divvied up over these shares that they have put out. So you're going to earn a nominal amount over a set period of time that you can turn around and put into other investments. So that's the one thing you want to take a look at. The other thing is, even though it's a low risk situation where they're already pulling gold out of the ground, you kind of want to make sure that you're still dealing in friendly territories.
Right, yeah.
For instance, it's estimated that by 2029, two of the top 10 gold miners are expected to become the world's top producer, basically turning Russia into the world's leading producer of gold in 2029. Now, take a look at how things are going right now between the Western world and Russia. Well, you may not want to put your money there. You may want to keep it local. Perhaps put it into Barrick. These are other big companies that are in Canada that may not be producing as much of these other guys potentially over the year, but you will always get your dividend, or you'll always get that growth story coming because, chances are that Canada is going to be around as a friendly entity in the next 10 years. So there you go there. That's my advice. Not a lot of advice. Perhaps you could have done without it, but there it is.
Hey, it's a safe play because a dividend means some level of stability.
Yes,
right?
Absolutely.
Let's face it.
That you can utilize immediately.
Right. And the more you have, the more your 1.1% adds up.
Yes.
That is streamers and royalty. That's the financial side of it. The juniors, which are exploring and digging and spending money trying to find it. And then there's the producers. They're making it and putting it right in behind, in the shelves there, right behind.
The customer here. So.
You lucky son of a something. Good work by all of you on this. We like these educational roundtables. I think people are digging it. And in this case, it's all about mining. It's mining 101. What we've told you is not guaranteed. If you're construing this as advice at all, please don't necessarily, and do your own research and homework when you're looking into investing in any of these forms of mining companies across the board. That would be good. For Vishal upstairs in the vault and Galen downstairs in the basement making brownies. And
it's been a long time.
Banana bread.
up in the corner, Fabi, who's making, what would she be making right now in Portugal? What could
I
you-
would be eating the brownies, not making anything.
Good for
It's
you.
nighttime there, right? So maybe chamomile tea or
That's the
something.
great end of the deal.
There you go.
The
That
eating.
sounds
The great end of the
good.
deal.
We're all going to eat brownies, and we're going to see you on the next Equity Guru Investor Roundtable.